Good morning, everyone. It is Monday, April the 20th, and welcome to 7 Investing Live. This is our live stream event we host every Monday, Wednesday, and Friday at 10 a.m. Eastern Time to put a spotlight on several of the stock market's most intriguing opportunities. My name is Simon Erickson. I'm founder and CEO of 7 Investing, joined by our executive producer of this live stream, Heather Horton. We are going to be talking today about the trade desk, which I have recently mentioned out on social media as one of the stock market's highest potential risk yet highest potential rewards opportunities right now. We're going to be digging into that one, but I do think I'd like to put up a disclaimer first that we recently recommended the trade desk as an official recommendation of 7 Investing. And a reminder, if you do sign up with 7 Investing, we don't just talk about stocks publicly like this, which is really fun and really cool. We also make official recommendations for any one of our members. And each and every month, it's a new pick that goes onto our scorecard, and we follow up with it for ongoing coverage as well. And so with the 7 Investing membership, which by the way is completely free for your first 7 days, you can get access to all of those previous picks, all of the follow-up with the premium coverage we have on those recommendations, and then also our 5 best buys each and every month for $200 a year or even just $17 a month if you want to check it out for a little while. And again, 7 days completely free. You get full access to everything at 7investing.com/subscribe. Heather, let's see if this actually works. Does long-term investing in individual stocks actually work? Yes, it actually does, and our scorecard transparently shows that. If you look at all the recommendations that I've made since starting 7 Investing 6 years ago, you can see it's an outperformance versus just investing in the S&P 500. And depending on how much money you're investing in these picks, that can be a sizable outperformance, real dollars and cents advantage when you're looking at the average absolute return of all the recommendations being 78% versus the S&P 500 at 50% in terms of absolute total return, not including dividends, over the same time period. You can kind of see a look at some of the different recommendations. These are, of course, examples. These are not the actual ones when you see NVIDIA and Meta in there. But the most recent recommendation was Coupang that I came out with in April 2026, and it was the trade desk in January of 2026. And if you notice, some of the total returns, especially there of the trade desk, have been kind of choppy here in 2026. We're going to dig deeper into that, figure out why, and then figure out whether the trade desk is a good opportunity now that it's off of its highs quite a bit. One more couple slides until we jump into the deep dive here. On the next one, we see here's kind of how the outperformance looks over time. You can see that we tend to do pretty good versus the S&P 500. My picks are on the blue line. S&P is on the orange line there. You also see that sometimes the market in 2022 doesn't go straight up and to the right. You've got to have patience to be a long-term investor. We're always investing with a 3 to 5 year time horizon. The trade desk is no different than that. Short-term underperformance, long-term outperformance is what makes the scorecard shine. And I think we might have one more slide in there. Remind me if we do or not. Oh, there we go, Heather. Cool. A lot of fun stuff going on in 7 Investing too. It's not just stock picks and recommendation reports and things like that. It's also trips to MIT to see what's going on, the newest technologies out there. We do a lot of conversations with CEOs. We even publish to China and other continents sometimes. And we have a good time doing it as well. So 7investing.com/subscribe if you want to get started. Again, I recommend everybody to go jump in, do a cannonball, yell YOLO, and jump into the deep end and see everything that we've got to offer. That's why we're giving the 7-day free trial absolutely free. Heather, we've been good friends for a long time. You've kind of seen this journey from the early days. It's kind of neat to be out there doing it in any year as an individual investor. We always think long term, but in any given year, there's always challenges and opportunities that present themselves, right?
For sure. Every year.
Absolutely. So let's jump into the trade desk. Let's talk about that one here today. I'm going to share a screen. Hopefully this is going to work out for me. And we'll look at the trade desk right here. Slideshow, opening it up. There's the share. Heather, could you give me a thumbs up if this is actually showing correctly?
It sure is.
Oh, wonderful. Okay, the trade desk. So this is a company. I'm not going to go too into the details of this, but I do want to point out this comes directly from the report that we published in January 2026. I rarely do this. I rarely share premium content that's in the free media like I'm doing today. But since we're talking about the trade desk, we did just recently make it a recommendation. I want to give a little sneak peek on kind of some of the content that we've talked about. The trade desk was founded by a gentleman named Jeff Green. Really, really smart guy. Started his career in Microsoft back in 2001. And he then went on to form what he called a demand side ad exchange. He described this, keeping in mind this is 25 years ago, as the New York Stock Exchange of advertising, where you could actually have an open auction. You could place bids on advertisement in real time, and the best bidder was going to programmatically win that. This was kind of considered the world's first demand-side ad platform that he started at AdECN in 2003. That company went on and got acquired by Microsoft 4 years later in 2007 to compete against Google, which of course was doing its own advertising on its search engine that it was building as well. He left Microsoft after it acquired his own company because he wanted to, quote, escape the bureaucracy and the internal politics. What is that like at a big company? You know, anyone who's worked at a large company knows how that can feel. And so 2 years later, he goes out and he founds the Trade Desk in 2009 with the chief technology officer and co-founder Dave Pickles, who was also from Microsoft. At this time, the digital ad industry was really the Wild West. There was not a whole lot of transparency into seeing the right pricing that would make sense based on the efficiency of what kind of return on ad spend you were getting. Right? There was just kind of, you're paying this, you were getting charged this much to place an advertisement in this website or this podcast or this app or whatever it might be. There wasn't a whole lot of analytics or transparency yet on how this was doing. And so what Green wanted again to see was a new trading floor, again, back to the New York Stock Exchange analogy, a new trading floor of internet advertising would facilitate price discovery and liquidity in the way that the public markets has for hundreds of years. Stock market investors like to have transparency in the fundamentals of the company that they're investing in how others are buying and selling that same stock, in the technicals, what kind of trading volumes are going on out there. Let's bring that same experience that the New York Stock Exchange has provided for years to the digital advertising world. And so there you see how the Trade Desk became the preferred demand-side platform of those who are the buyers, the ad agencies who are placing advertisements in available inventory on the internet, setting up a new platform to more accurately identify the available inventory from the publishers and confirm it was actually human beings who were viewing and engaging with those ads. You're not just racking up unnecessary spend because bots or other things were looking at your ad. So I'm having a little bit of fun when I described this back in January. We're going with the Star Wars analogy because that's the movies that my 4-year-old loves right now. So the past was A New Hope, the Star Wars, the new hope of the past. The Trade Desk made a ton of money doing this. And in fact, if you look at just a couple of years after their IPO, they've been profitable since the year 2013. You kind of see how quickly this has grown. Of course, programmatic advertising was superior to newspaper ads or radio ads or even simplistic internet display ads. The Trade Desk caught on extremely well over the past 10 years or so. And so you can see here, in the 8 years since the company's IPO, you have seen a 25x growth in terms of revenue and gross ad spend over the Trade Desk platform, right? This has been incredibly profitable. Other ad formats have not done as well as the Trade Desk programmatic ad platform. That's why you see the budgets moving to that. And then in 2024, that's 2 years out from now, we were at $12 billion gross ad spend, the Trade Desk capturing around 20% of that for their own revenue. Again, this is a percentage you take. If you spend $100 million on advertising over the Trade Desk platform, they're going to take $20 million as their cut of this. So things went really, really well, right? This is a company that did very well for its investors. In fact, from the IPO up to 2024, a 3,800% investment return. That's pretty nice when you get almost a 40 bagger. For every $1,000 you would put into the Trade Desk from the IPO, you're now sitting on $40,000. This was probably putting a lot of people into early retirement or a new boat or a new home or a new car based on its returns. It seemed like it was doing incredibly well, significantly outperforming the broader S&P 500. Oh, but goodness gracious, look what happened in 2025. The Empire Strikes Back last year. All of a sudden, the Trade Desk is facing a flurry of new challenges. First and foremost, we know the T word, tariffs. Tariffs push up the prices of anything that a company might want to be advertising. And when things are more expensive and people are paying more money for gas at the pump or for everything else in their lives, they might be spending less on consumer discretionary spend. You see a lot of marketers or analysts in the industry cutting their forecasts on overall advertising spend in 2025. That actually did happen. We ratcheted down pretty significantly, just overall spending. Just people were spending less money because things were more expensive out there. In addition to tariffs and the prices of goods going up, we also saw there was new competition for the trade desk out there. Keeping in mind, Jeff Green was undoubtedly the innovator in this space. He was several lengths ahead of his competition in this horse race that was digital advertising that was programmatic. And then all of a sudden, you've got new rivals. Amazon went out there and poached Walmart as a new customer. They also went out there and started working with Netflix. Keeping in mind that both Walmart and Netflix were exclusively working with the trade desk as a DSP before. They didn't lose the trade desk as a customer. They just decided they're going to start dating other people. All of a sudden, Amazon is going in there and undercutting their pricing, making it much less expensive as a DSP partner to place ads for the open internet. Prebid.org. This was one of the earliest kind of open source platforms for real-time bidding, right? Decided that the trade desk unified universal identifier was being used in header bidding extra process that was giving it way too much power to the buyers. We wanted to have this a little bit more of an equal playing field for both the buyers and the advertisers and the publishers, the sellers that were putting ads out there. So they actually worked the trade desk out of the open source protocols that they were using out there. And so what does the trade desk do in response? Well, they say, okay, fine, if you're going to do that for your own auctions, we're going to create our own open ads auction process that is still going to be using UID 2.0. Again, when the industry wants to go one way, the trade desk, being the innovator, has always said, no, we think we've got a more efficient solution. We're going to do it this way. And for those who have been following the story here recently, just last month, some of the trade desk's largest customers, including the French advertising conglomerate Publicis, has said, we're going to conduct an audit on how you're actually charging us. That is typically a bad sign when a customer who accounts for almost 10% of your gross ad spend is saying, we think that you've been billing us incorrectly for the last couple of years. It all goes back to the take rate that the trade desk has been charging. You would think that is a simple variable calculation, right? If you spend $100,000 in advertising, it's a 20% take rate. You should be spending $20,000 to the trade desk for that, right? 20% of $100,000 spent. However, there are other fixed fees that are also included in there as well. A media fee, a data fee, perhaps whatever other fees that are fixed costs that you pay every month as well to the trade desk, that the trade desk has unapologetically also been applying its 20% take rate to as well. So if you paid $100,000 over the year and say another $10,000 in fixed fees over the year, you would actually be charged $22,000, 20% of $110,000 versus just $100,000 on ad spend. This is enraging a lot of customers. They had nobody else that they could go with before. Now, all of a sudden, the Amazon DSP has got fully transparent pricing, which is calling into question a lot of customers of whether they actually want to exclusively be working with the trade desk anymore. And so this is what happened in 2025. All of those bad news, perfect storm of bad news for the trade desk. All of a sudden, we are not sitting at a 4,000% gain anymore. We all of a sudden see the trade desk stock drop by almost 70% in 2025. Massive reversal of one of the market's most compelling and most intriguing investment opportunities of the past decade. And so where do we stand today? Let's go to the future, the return of the OpenPath. The trade desk, being the innovator that it is, says, okay, if this is the real-time auction process that digital advertising has always had, but it's kind of inefficient and we're losing a lot of money in the middle due to those inefficiencies, due to those middlemen kind of capturing, 5%, 10% take rate where it is. What if we could bypass the existing auction process that we have and just have an open path that would immediately link the advertiser itself, you want to place an ad, and a very, very large publisher that would have available inventory, such as the Washington Post. The Washington Post, one of the largest publishers out there, says, okay, Trade Desk, can you link my website, which now has an open inventory spot, an open ad spot on this article, rather than me going out there and farming that out through the digital advertising auction process, which we've used for most of the last 20 years, can you just link me to an advertising agency that would place it directly for them if they know exactly what kind of audience they want to be available for? I want to be available for somebody that's in their mid-40s, that loves the investing industry, maybe loves the New Orleans Saints. And by the way, the New Orleans Saints is going to be offering some merchandise, some jerseys for them. So it's going to show up just for Simon Erickson when he visits the Washington Post. The trade desk can now do that without needing the embedded analytics of the real-time bidding process. And so OpenPath has always been this idea that the trade desk has beta trialed out there, but it hasn't gone mainstream because it's going to blow up a lot of the relationships and a lot of the existing infrastructure that's being done for real-time bidding. Keeping in mind, the trade desk wants to keep its customers, the advertising agencies, very happy. So could this catch on? Could OpenPath truly be the future? Can we level the entire playing field for the entire industry, change this entire massive industry that's out there, that's $1 trillion right now, based upon a technology that was developed by one company? Maybe OpenPath is the future for digital advertising. And again, the goal is to make a much more efficient system. No advertising agency wants to spend more than they have to get their advertisements placed within a publisher's open inventory. And every publisher wants to get maximum advertising spending. You want to have that gross ad spend fall right to the publisher as efficiently as possible because that means they're making more money. Can we rewrite the entire system of how digital advertising is being done today? Keep in mind, this is kind of how hundreds of different players looked out there a couple of years ago. All of a sudden, you might be not needing as many middlemen anymore. Could OpenPath bypass any of those steps between the demand-side platform and the publishers itself, which could be a combined 5 to 30% of all money spent on gross ad spend? That's why this is interesting. And so the pie is getting bigger while waste is being pushed out again. You want to have a publisher collecting more than 55 cents of every dollar of ad spend by the advertisers just by making the system more efficient. That's what the trade desk is trying to do out there. That's why you see a wolf that's in sheep's clothing out there. OpenPath could be disguised today as a beta test idea, but something that could reroute this entire industry, which, keep in mind, last year in 2024, 2 years ago in 2024, was worth $935 billion globally. And then in 2025 was worth more than $1 trillion globally. And about 28% of that being involved in the open internet, which is not behind a walled garden of Google search, not behind a walled garden of Facebook on social, not behind the traditional inefficient media that's out there today. That's why the trade desk has got such an opportunity today, but it's also being plagued with some short-term problems it's going to have to overcome if it wants to get through this funk that it's in right now. And so once again, I encourage everyone, we've given a brief vignette, a 10-minute overview of what's going on with the trade desk. We go much deeper than this into the trade desk opportunity and the competition and a discounted cash flow valuation to establish what a fair value for the stock is. I would recommend anyone watching this show to check out 7investing.com/subscribe. Click right into 7investing.com/recommendations and look at January 2026 to see the trade desk, to see why it is that I still think there's a lot of potential out there. But Heather, back to there's no free lunch in investing. There's no obvious, easy answers in this industry. The trade desk has to continue to execute here in 2026, knowing that it's got a lot of challenges here in the short term. But if it can get past those, if it can handle the tariffs, if it can handle the competition that's going on out there, it can handle these audits that its customers doing. This is $1 trillion market that it's always been several steps ahead of its competition. It's there for the taking. It's just going to have to do things right as it gets through these tough challenges here in 2026.
Yeah, I find that really reassuring because I own the trade desk and I've watched it whole limit. So hopefully that will go. When you say Amazon is cheaper and more transparent in their pricing, I mean, how much cheaper are we talking about from the 22% with taxes and fees and whatnot? Do you know about how much Amazon costs?
I sure do. And in fact, leading up to the answer for that, let me do a bit upstream and say a lot of publishers didn't actually want to work with Amazon for years. Why? Because if you're a retailer, you're directly selling to consumers, my Saints jersey example, if you're working with Amazon and they're controlling the relationship between your advertisement and the publishers, Amazon is probably learning who's buying your products And then guess what? They're probably going to be selling some of their own, like Amazon loves to do. And Amazon also has got its own publishing arm. Amazon Prime has got, all of the digital media that I like to watch for free as well. So it's going to kind of prioritize its own advertising within its own channels as it was. But Amazon also isn't dumb. They see that there's a huge opportunity, and the trade desk has made a lot of money over the last 10 years or so. And so they said, you know what, maybe we can actually carve out a bit of our own demand side platform. It's got a really nice tech stack attached to it. And so let's say the Amazon DSP is going to be available for the open internet. Doesn't just have to go through the Prime channels, doesn't just have to go for, the customers that we want it to be. And we're going to open it up for everybody. And by the way, the trade desk has been charging you 17 to 20% of the take rate. We're going to make it available for 10%, which is about the split right now, about half price. And so, if you're a company and you're spending a lot of money out there, Netflix, Disney, Walmart, you might start saying, yeah, I'm okay and I'm comfortable enough with Amazon, being that the savings that I'm going to get is going to directly translate into dollars and cents. And so I think that the first...
Oh, I was going to say, you're paying with your data as well as cash at that point.
100%. So it's the shot across the bow. It's Amazon testing out how large of a customer can it get, and who's willing to work with them. And I think that the natural response, if you're the trade desk, is you've got to be more competitive in the pricing. Will you stay with me if we're going to offer to you for 15% instead of 20%? Typically, when there's a new, very highly capable competitor like Amazon in the room, you've got to make sure that you're not dropping those opportunities entirely.
Has Trade Desk started offering lower prices? Do you know?
I haven't seen it yet in the take rates, at least in 2025. We are seeing a lot more pushback here with the Publicis, French conglomerate. That's their largest customer, about 10% of gross ad spend. If they come back with the audit and they say you're overcharging us and we don't agree with your fees anymore, it's going to be kind of defining how the trade desk handles that. If they stand firm and they say, nope, this is the pricing, this is what you're getting it, here's the value, Mr. Customer, that's why we're sticking with this. If Publicis says, okay, we accept that, then probably all the other customers will follow suit. But if the trade desk gives some concessions, probably the other customers that they have too are going to say, hey, we want the same deal that they're getting. We don't want to pay 20% if they're paying 15%. It might be across the board a reduction, in not only top line revenue, but also margins.
Mm-hmm. Which would be really a hard hit to them. But also the stagflation we're dealing with is not, and the tariff pressure probably is not going anywhere immediately. So that pressure is going to continue. So it'll be interesting to see what their new method does for them. And then internet marketing in general is just a very interesting space because you can track it. Unlike, TV and radio, it used to be you would put out ads and you have no idea how many people heard it because it just went out on the air. And there's just no way, like, you could do surveys, but that was about it. There's no other way to really know how many people heard or saw. But internet advertising has such direct, exactly who saw it, who bought from it. It's much easier to track and prove if it's working or not, which does give them a leg up if it's working and they're able to target really specifically.
That's 100% true. And if I can close this out by my strongest statement is the strongest bull statement for investing in the trade desk today, it is that Jeff Green is an innovator that moves very quickly. The trade desk has been around a long time, and this is an industry that moves very fast. And it's either kill or be killed. If you're not showing returns for your clients, you're getting displaced next year because it's super competitive and advertising is based upon return on ad spend. And what has the trade desk done every single year? It faces a challenge. It adapts, it evolves, it reconfigures, and it launches something new, right? Just like its own programmatic platform was in the first place. Just like when it launched Kokai, the AI, accompaniment to it to start directing the ads using AI, just like it did with Open Ads. Now all of a sudden you've got a new auction that it's built itself in response to what Prebid did. Just like what it did with OpenPath. It says, okay, if you want to have all this efficiency, I'm going to offer you a way to be more efficient. Its customers know this, right? Its advertisers know it's the best and it's the fastest moving. And it's large enough now too, that it's pretty well embedded. And I think these challenges, I'm not actually worried about the tariffs 5 years out. I think that's going to resolve itself consumer discretionary spend is coming back. I recognize that competitive threats, that's something you have to watch out for as an investor. That's a big deal, right? And of course, these auctions, these are a big deal too. If you start losing customers, your customers are all leaving. There's an exodus because of these auctions or these audits that are going on. That's a big deal. That's a big risk for us as investors. But I've also seen these a lot. I've been invested in the trade desk for a long time. I've seen them face challenges like this before. And Jeff Green is not giving up. He's not going to throw in the towel. He's one that embraces these challenges, and he goes out and he does something about it. And so I think that's what we're going to see in the trade desk in 2026. He's already aware of what's going on out there, and he's getting to work. And I'm still pretty confident as a long-term investor, recognizing we've got some new things on the table we got to be addressing.
The importance of investing in CEOs you trust and admire.
100%. So I think that'll close it out here. We talked about the trade desk. Again, a little bit of a sneak peek in the deep dive. Again, I've been promoting our 7 investing service pretty heavily here because I do want you to go check it out. We've got a community forum where we're bouncing ideas back and forth on the trade desk as well. That's included with your membership. And you'll also get included access to the full discounted cash flow where I have a base case fair value per share. No spoilers, not giving that away just yet, but it's out of sync with the current stock price. I will say that. So go check that out, 7investing.com/subscribe if you want to get take a look at our service more deeply. And one more thing that's coming out today, we talked about the trade desk here on this show, but later this afternoon, I will be releasing my dozen strong buys for April 2026. These are the 12 companies on our entire scorecard of recommendations that I feel most confident about right now. And then, of course, tomorrow, we're going to go down from those 12 strong buys to 5 best buys for April. Always a highlight every month is seeing the highest conviction ideas on the scorecard. So we'll wrap it up with that. That was the trade desk, a TTD for anyone who wants to follow along with that stock. And looking forward to releasing, again, some of our highest conviction ideas here later in the week. Stay tuned. We'll be back again. We're another 7 Investing Live, Monday, Wednesday, and Friday at 10 a.m. Eastern Time. In the meantime, stay safe and have a wonderful week.